Part 2, weighted average cost of capital. This part, we will learn how to get the overall cost of capital for the firm. The overall cost of capital for the firm should be simply weighted average cost of capital, which is also called WACC, WACC. This WACC is the overall required return on the firm's assets based on the market perception of the risk of those assets. The weight is simply proportion of each type of financing relative to firm value. We should use target weight if possible. If not, we may use market value to find weight. As shown in the formula, WACC is weight on equity times the cost of equity plus weight on preferred stock times cost of preferred stock plus weight on debt times after-tax cost of debt, which is before tax cost of debt times 1 minus tax rate. From the data, let's find weight on each type of financing. Current stock price is $50 with 3 million shares outstanding. The value of preferred stock is $25 million, and the value of debt is $75 million. Tax rate is 21%. Find weight. To find weight, we need to compute the value of each type of financing. The values of preferred stock and debt are already given, 25 million and 75 million, respectively. So we only need to compute the value of equity. The value of equity is stock price per share times number of shares outstanding. $50 times 3 million equals to $150 million. So total firm value is sum of these three values, 150 million plus 25 million plus 75 million, $250 million. Weight on equity is 150 million divided by equity value, divided by firm value, 250 million, 60%. For preferred stock, 25 divided by 250, 10%. And for debt, 75 divided by 250, 30%. Now, given the cost of each type of financing here with 21% tax rate, let's compute WACC. WACC is weight on equity, 60% times cost of equity, 14% plus weight on preferred stock, 10% times the cost of preferred stock, 9% plus weight on debt, 30% times before tax cost of debt, 10% times 1 minus tax rate 21%. 11.67% is weighted average cost of capital. Pop quiz 4. Compute WACC of following data. Let's find weight on each first. Weight on equity equals to stock price 40 times 2.3 million shares outstanding, which is $92 million, divided by total firm value, which is 92 million equity value plus 50 million preferred stock value plus 50 million. $157 million. 58.6%. Weight on preferred stock equals to 15 divided by 157, 9.55%. Weight on debt is 50 divided by 157, 31.85%. WACC is weight on equity, 58.6% times cost of equity, 15.6%, plus weight on preferred stock, 9.55% times 4.84%, cost of preferred stock, plus weight on debt, 31.85%, times before tax cost of debt, 7.37%, times 1 minus tax rate, 21%, 11.24%. Summarizing chapter. Cost of capital is the required returns earned on assets, depends on the risk of those assets. A firm's cost of capital indicates how the market views the risk of the firm's asset. So, a firm must earn at least the required return to compensate investor for the financing they have provided, which may be used as an appropriate discount rate in capital budgeting project. Which factors influence the company's WACC? Any factor that may affect the firm's cash flows will affect the company's WACC, especially market conditions such as interest rate, tax rate, and the market risk premium. The firm's capital structure and dividend policy and the firm's investment policy are critical to determine company's WACC. In conclusion, firms with riskier projects generally have higher WACC. This is the end of chapter 12. Make sure that you understand and compute company's WACC. Thank you and goodbye.